Imagine getting paid every single month just for holding a few ETFs. No waiting 3 months for a dividend check, no complicated stock picking. Just steady cash flow landing in your account every 30 days. In this video, we're covering the best monthly dividend ETFs for 2025 and how they can fit into a passive income strategy. Welcome back to Asset Index. Here we break down ETFs, dividends, and passive investing strategies to help you build wealth long-term. Today we're diving into 3 popular monthly dividend ETFs, JEPI, QYLD, and RYLD. These funds have attracted billions in assets because they offer something investors love, consistent monthly income. But as you'll see, high yield always comes with trade-offs. Section 1. Why monthly dividends matter. Most ETFs and stocks pay dividends quarterly, but for people who want income they can actually use to pay bills, reinvest, or cover expenses, monthly dividends feel more practical. That's why monthly dividend ETFs have become so popular. They're especially appealing to retirees and passive income investors who want predictable cash flow. But here's the catch. Many monthly dividend ETFs use covered call strategies. That means they trade off some upside growth for higher, more consistent income. So let's break down the top 3 options. Section 2. JEPI. First up, JEPI, the JP Morgan Equity Premium Income ETF. Strategy. JEPI invests in large US companies, similar to the S&P 500, but it also sells covered call options on those holdings. This generates extra income, which gets paid out to shareholders monthly. Dividend yield, around 7 to 8% as of 2025. So a $100,000 investment could generate roughly $7,000 to $8,000 per year in dividends. That's nearly $600 to $650 per month. Pros: steady monthly payouts, lower volatility than the S&P 500 due to the options overlay. Backed by JP Morgan, a trusted institution. Cons: covered call strategy limits growth. You won't capture all the upside in strong bull markets. Dividend yield can fluctuate depending on market volatility. Overall, JEPI is considered one of the more balanced high-income ETFs. It's less aggressive than some competitors, which makes it popular with income-focused investors. Section 3. QYLD. Next up is QYLD, the Global X Nasdaq 100 Covered Call ETF. Strategy. QYLD holds the Nasdaq 100, companies like Apple, Microsoft, Amazon, and Tesla. But it sells call options on the entire index every month. This generates very high income. Dividend yield, around 10 to 12% as of 2025. On $100,000 invested, that could be $10,000 to $12,000 per year, roughly $900 to $1,000 per month. Pros: extremely high income potential, exposure to top tech companies, consistent monthly payouts. Cons: limited price growth, the option strategy caps upside. Returns may lag behind the Nasdaq 100 significantly over time. Not great for long-term compounding, but strong for cash flow. QYLD is appealing if you value income above all else. But it's important to understand that you're giving up growth potential for those double-digit yields. Section 4. RYLD. Third on the list is RYLD, the Global X Russell 2000 Covered Call ETF. Strategy. RYLD invests in the Russell 2000 Index, small-cap US companies. Like QYLD, it sells call options on the index to generate income. Dividend yield, around 11 to 12% in 2025. That means $100,000 invested could pay out about $11,000 to $12,000 per year, or nearly $1,000 per month. Pros: high income potential, similar to QYLD. Adds small cap exposure, which SCHD and other large cap ETFs don't cover. Cons: small cap companies are more volatile and risky. Covered call strategy again limits growth potential. Total returns may lag long-term. RYLD is a niche play. It gives you both small cap exposure and monthly income, but comes with added risk compared to JEPI and QYLD. Section 5. Income examples. Let's put this into perspective with income examples. $10,000 invested in JEPI at approximately 7.5% equals about $750 per year, or $620 per month. $10,000 in QYLD at approximately 11% equals $1,100 per year, or $92 per month. $10,000 in RYLD at approximately 11.5% equals $1,150 per year, or $96 per month. Scale that up to $50,000 or $100,000, and you're looking at monthly income that could realistically cover some bills. But remember, high yield comes with risks. These ETFs are best understood as income tools, not growth engines. Section 6. Risks to watch. High-yield monthly ETFs may look attractive, but they're not for everyone. The covered call strategy limits long-term capital appreciation. Dividends can vary depending on market conditions. Inflation can eat away at fixed income streams over time. That's why many investors choose to mix a high-yield ETF like JEPI with a growth ETF like VOO or VTI. That way you get both cash flow now and growth for the future. Conclusion. So, what are the best monthly dividend ETFs for 2025? JEPI gives you balanced income with lower volatility. QYLD offers sky-high yield but limited growth. RYLD brings small-cap exposure with strong income potential. Each has its strengths and weaknesses. The right one depends on your goals. Do you want stable income, maximum yield, or diversification with risk?